Many people view accounting as number crunching with limited or no impact beyond the bookkeeping of a company. This is a very limited view of accounting, as it fails to consider the impact that reported information would have on investors, creditors, trade unions, and other stakeholders who would rely on financial statements of a company. Accounting and accountants have the potential to have major impact on society. For example, the failure of accountants to perform their roles effectively led to major corporate collapses such as Enron in the US and Parmalat in Italy. In this knowledge clip, we will look at how accountants can have an impact on society. The major role of accounting is reporting. This can take a number of different forms such as the annual financial statements, half-yearly and quarterly reporting. These reports provide information to stakeholders, which in turn is pivotal in influencing their decision-making capabilities. Stakeholders range from owners, management, investors, to potential investors and other interested parties. So for example, assume Ben is interested in purchasing shares in a mining company. Prior to purchasing shares, Ben would look at the annual financial statements and other reports that are available. These reports would provide vital information that would influence his decision to purchase the shares or not. Based on the reports, Ben decides that the company is profitable and is a great long-term investment. Now let's assume that the reporting which influenced Ben's decision was accurate. In this case, Ben would be appropriately informed and his decision to buy the shares would have positive social consequences. In other words, the active social impact that accounting played in Ben's decision would be a good one. In more technical terms, Ben and other investors like him would be allocating their scarce resources in an appropriate manner that would benefit them, the organization, and the broader economy. Other groups linked to the company, such as lenders or suppliers, will also be making similar decisions about whether to transact with the company or not. If these decisions are linked to accurate information, they will lend and sell wisely and see growth in their own businesses. However, if the reports that Ben and other stakeholders relied on when deciding to purchase shares were inaccurate or wrong, Ben and the other shareholders might lose part of or all their investment. Lenders may not receive principal repayments, and suppliers may end up with bad debts instead of increased profits. Employees might lose their jobs and may not be paid out their full entitlements. Therefore, the reporting by accountants could have positive social impact if it is correct, or could have negative impact if incorrect. In order to prevent a negative social impact by inaccurate or poor reporting, accountants have to apply vast professional capabilities, including technical and soft skills, as well as extensive experience.